Hello, I'm Louise Macaulay and welcome back to Dugas Copy TV. It's Friday, which means it's time for the weekly wrap-up. So joining me on the line is Mike Jakeman from the EIU. Now, Mike, we've seen a drop in Chinese GDP this week, and the Chinese government is expected to lower its official target from 7.5% last year to 7% this year. The IMF have predicted an even lower growth rate of 6.8%, while India's economy is expected to expand by 6.5% this year. Are these figures in line with your expectations, and could India overtake China this year in terms of economic growth?
In answer to the first question, we're actually a bit more confident on China this year and are expecting growth of 7.2%. We were around about 7% up until about 6 weeks ago, when we really took into account the effects of lower oil prices, which we think will have a small but nonetheless noticeable boost on the Chinese economy. In terms of China and India, the long-term trend is that we think India is sort of roughly about 20 years behind China, and the demographics will begin to take account of China in the next few years. So eventually India will start growing at a faster rate than China, but that's not going to happen this year. We've got India at about 6.5%, which is probably a slightly optimistic forecast, and is based on the fact that the new government will make some reforms that will generate some growth, and that also India will benefit from lower oil prices. But I think it could be 5 years or longer before we start seeing 7% every year in India.
UK employment figures show a drop of 0.1% this week. However, companies are still looking to recruit, especially in the construction sector. What effect will this scenario have on wages?
Wage growth is definitely accelerating in the UK at the moment, and we've got it at around 1.8% this year, 2015, which represents a two-year high. This reflects the fact the economy is strengthening. The downside risk, I guess, to wage inflation is a wider fall in consumer price inflation. Sorry, I mean a slowdown rather than a fall. So because of lower oil prices, again, we've seen the expansion slow in inflation this year in the UK, and around about April we think we'll kind of reach a trough in inflation, and that of course is a time when lots of new salaries are negotiated. So that's a downside risk, but in general we think that the strength of the economy and the fact that there's probably been a bit of pent-up demand being released now as well after years of underperformance following the recession means that we're relatively confident that the wages will grow this year, and by a decent rate.
The Bank of Canada cut its interest rate by 0.25% on Wednesday. Some analysts believe that the BOC have joined the policy error club. What is your take on that? And also, what effect will the move have on the Canadian consumers?
I actually disagree with this fairly strongly. I think the point of the interest rate cut was the fact that the Bank of Canada is trying to hedge again declining oil prices. You know, this is an effect we're seeing across the global economy, that everybody's reacting to oil at the moment. Canada, of course, is a big oil exporter. It's one of the biggest in the world, and they're trying to make sure that growth doesn't slow and inflation doesn't slow too much. And they've acted quite early, which I think is quite prudent. The effect on consumers is, I guess, a risk and an opportunity. It's a risk in the sense that Canadian consumers are very, very indebted, among the most indebted in the world, and we haven't seen the kind of deleveraging in Canada that we've seen in the US and a bit in the Eurozone either. The debt-to-GDP ratio is dizzying. So there is a risk that if Canadian consumers go out on another spending binge, that ratio could rise even further. But I think that the general feeling about Canada and in Canada at the moment is that lower oil prices are going to slow the economy, and I'm not sure that consumer confidence is high enough for this interest rate cut to generate a worrying rise in consumer confidence. I think it's a small adjustment and probably quite a good one for Canada.
The ECB held interest rates at 0.05% on Thursday. Following the press conference, what are your forecasts for the single currency?
I mean, the story really, of course, is all about QE and the fact that the ECB has finally moved and pulled its kind of biggest policy lever to try and generate some inflationary pressure and faster growth. Our view is relatively bearish on the likely effect of QE. It was bigger than we expected it would be. I think lots of people were taken slightly by surprise by the size of it. But we think that the Eurozone's real problems are structural. Monetary policy has been behind the curve throughout the whole crisis period. Until, although they've now made this significant move, but until there's some real willingness by politicians to pull the kind of fiscal policy levers and spend a bit more, particularly, of course, Germany, but also structural reforms are needed in France and Italy. I'm not sure that QE will generate as much of a boost for the Eurozone as the ECB is hoping.
Well, Mike, thank you very much for joining me. That is all from me today, but have a great weekend.